Welcome, everyone. Thank you for coming out on this sort of chilly autumn evening. We might burn John if he doesn't tell us the right things, and we'll have a fireplace going. All right, so this is a special lecture. It's a part of a 2 nights lecture series. It's the annual Ulam lecture series, named after Stanislav Ulam, the Polish-American mathematician who worked on the Manhattan Project. He invented a whole range of extraordinary techniques, including cellular automata, the Monte Carlo method. He suggested nuclear pulse propulsion, which is an intriguing way of sending rocket ships out into space, and he has many other accomplishments. He also wrote a beautiful book called Adventures of a Mathematician. And I think I have a quote from that book that seems very fitting for what's going on in this country over the last couple of weeks, or the world, I should say. And he wrote, with respect to his experiences working on the Manhattan Project, "Sometimes I feel that a more rational explanation for all that has happened during my lifetime is that I am still only 13 years old, reading Jules Verne or H.G. Wells, and have fallen asleep." Right. Time to wake up. Let me just recognize Claire and Steve Weiner, who are here tonight, and they're over there somewhere. I can't really see you. But Claire is Stan Ulam's daughter. And so just a round of applause for the extraordinary family. And we're sort of delighted that the Weiners remain involved with SFI, support SFI, and come to all of our events. Thank you to Thornburg Investment Management for their support of the series, and of course to the Lensic Theatre for hosting these lectures. So tonight and tomorrow, so if you came tonight, come tomorrow. Today is an appetizer, tomorrow is the main course. If you prefer, today is the main course, tomorrow is the dessert. You pick. And our speaker is John Giannakopoulos. He is the James Tobin Professor of Economics at Yale and external professor at SFI. John got his BA in mathematics from Yale and his MA and PhD in economics from Harvard, working with the Nobel laureate Kenneth Arrow and Jerry Green. So at SFI, the social sciences and natural sciences have always coexisted, intermingled, conjugated, and reproduced. And starting very few years after, we were founded in 1984, and as early as 1987, and running for a series of years, Ken Arrow, John's advisor, the Nobel laureate, working with another Nobel laureate, Phil Anderson, convened a series of meetings at SFI to apply concepts of evolution to the creation of a new economic theory. And John sustained that ambition, and in 1990 to 91, and then 1999 to 2000, he directed the economics program at SFI. And in fact, as early as 1991, John was exploring the role of machine learning and statistical inference to predicting financial systems, which of course has now come of age. John is in many ways pre-adapted to life at SFI. What does that mean exactly? It means that in 1970, he won the United States Junior Open Chess Championship. And at SFI, we've long had an interest in combinatorial games of zero chance, chess and Go, and so forth. John's dad was also a professor at Yale. And he was actually professor of Byzantine culture and religious history, wrote many beautiful books. And I was told that when John first got to Yale as a professor in 1980, they would give lectures in parallel. And his dad's lectures would be attended like this, hundreds of people fawning after him and hanging on every word. And John would have about 3 people in his audience. So he's moved on. So I should say that since the onset of the late 2000 financial crisis, John's work on the relationship between leverage and asset prices, the so-called leverage cycle, has been prominent in both popular and academic discussions on market fluctuations and regulation. John also has an applied side, like many SFI-affiliated faculty, and he was one of the founding partners in 1995 of Ellington Capital Management, where he remains a partner. I just want to make a personal note about John, and then I'll hand over to him. Over the years, John and I have maintained a collegial, and some people might claim childish, debate on the precedence of evolutionary thought over economic thought, my position, or economic thought over evolutionary thought, John's position. And at stake is whether the combination of Adam Smith and Malthus recognize the essential role of competition and resource distribution as a foundational force for order, which John claims, or whether they overlooked the evidence, stumbled about the crime scene, as most economists are wont to do, and where it took the originality and genius of Darwin to solve the great puzzle of nature. The argument is futile. I'm right. But it does give you a sense of how these different great intellectual traditions can begin to be integrated. Just in closing, just to say that John was elected a Fellow of the Econometric Society in 1990, the American Academy of Arts and Sciences in 1999. He won the Samuelson Prize in 1999 and was awarded the first Bodesaki Prize in Economics in 1994. So, John, take it away.
Well, thank you very much. It's David for introducing me. It's a pleasure to be back here in Santa Fe. I never met Stanislav Ulam. I didn't see where his daughter was, by the way. Where is she? Oh, there you are. Hello. So David reminded me about chess in Santa Fe and machine learning. And one of my first papers I wrote in Santa Fe was called "When Seeing Further Isn't Seeing Better." And I attempted to explain how chess algorithms worked and basically tried to show that a computer would never beat Garry Kasparov. And I presented the paper to Garry Kasparov at lunch just a few months before he was defeated by a computer. But so the subject of my talk is debt and its discontents. It's something that everybody knows about because almost everybody has been in debt at one point and thought about lending money or borrowing money. Debt's plagued multitudes for millennia. It's caused, debtor's prison. It's caused booms and busts, wrecking economies. We've created central banks to manage credit. We created macroeconomics to study these booms and busts and how the credit was managed. We've had thousands of years of philosophers talking about debt and what it means. And with all that, we couldn't stop the Great Recession of 2007. So somehow, after all that, the macroeconomic consensus that had emerged before the Great Recession needed a little fine-tuning. And so I'm going to present a proposal to change the macro consensus in central bank policy. As David said, I call it the leverage cycle. And I'm going to say that actually it's quite consistent with what all those philosophers were talking about all those thousands of years. In fact, they might have anticipated the whole thing if they had added a little mathematics to what they were doing. I'm going to tell you some other alternative theories from after the crisis. Actually, the leverage cycle was from before the crisis. And I'm going to explain what mathematical economics is and why it's useful to do mathematics and economics. Almost everything that you hear about debt, you can tell a story about. So what's the point in mathematics? Well, the person who had the greatest impact on making economics mathematical, not the first, but the one with the greatest impact was Kenneth Arrow, my thesis advisor, who David referred to, and the starter, as it were, of the economics program. So I'm going to explain a little bit what he did and how my theory fits into that and why he didn't think of it. And then, then I'm going to, in the next lecture, flesh out the leverage cycle and try to make it a little more practical and try to explain what happened in the crisis here, the Great Recession in America, and what's happened and still happening in Europe, although both places are getting a little better now. So I probably don't have to remind you that the Great Recession was pretty bad. This is a picture of GDP from 1930 to actually to last year or the year before. I forgot to update this slide. And you can see that it goes steadily up. It has these little blips downward, but every time it has a little blip downward, I'm starting after the depressions. That was a big blip downward. But after that, from 1930 to 2008, 7 or 8, every time it went down, it quickly recovered. So if you look at how fast it was going up, it blips down a tiny bit, then goes up faster to catch up to where it would have been before. Those were all the recessions we had before. But look at what happened in 2008 there. It went down a whole $1 trillion. It had been going up $1 trillion the previous few years, the slope. So you could say GDP was down $2 trillion compared to what it might have been without the Great Recession. And every year after that, it hasn't caught up to where it's been before. It's still parallel to what its old trajectory was, just $1 trillion or $2 below what it was. So, you could probably overestimate the cost of the recession this way, but this has been going on for 8 or 9 years, $1 trillion or $2 trillion less than what you might imagine it could have been. We might have lost 10 or 15 trillion dollars in the Great Recession. Think of what we could have done. The Iraq War was 2 or 3 trillion. We could do a lot with $15 trillion, and somehow we didn't avoid it. So it's a mistake that needs to be rectified. It didn't just happen in America. Here's an updated picture. It's happened all over Europe. So this is GDP in a bunch of different countries, including Japan and the US. And you can see that all of them, Spain is the top one. They started 100, I normalized it to start at 100 in 1980. They're all cruising up. And then there's this big crash. And almost all of them, they don't improve much. The worst one is Greece that I'm going to be talking about. It hasn't grown at all since the crash there. The others, they pick up a little bit, but they never catch up to where they would have been before. So year after year after year after year, every one of these countries is losing output, losing potential income that they could have put to some good use. You'll notice, by the way, that Germany and Japan, they have a tiny blip down, and then they do catch up to where they were before. But I'll come back to that later. So what is the consensus? What was the consensus? I'm sure you know it yourselves. You just read the newspapers, and you know what the basic story of macroeconomics is and what the Federal Reserve is supposed to do. The basic idea was always, this emerged, from Keynes onward. It was worked over and over again. The basic consensus was, well, sometimes demand is too high and sometimes it's too low. Sometimes there's too much inflation, sometimes there's too little output. And the Federal Reserve, by adjusting the interest rate, when things are too hot, it raises the interest rate. If things aren't going very well, it lowers the interest rate. By adjusting the interest rate, it can restore the natural path of the economy. And for a long time, it kept things on a very even keel. Now, people, including Keynes, recognized that if the interest rate were 0, there wouldn't be any room to adjust the interest rate down. And so there was a little problem at the 0 lower bound, which we're, of course, near now. But other than that, it was all about adjusting the interest rate. If you read the newspapers even today, after the crisis, and they talk about Janet Yellen, what are they talking about? Janet Yellen, by the way, was a graduate student at Yale, about 4 or 5 years ahead of me, and then also an assistant professor at Harvard 4 or 5 years ahead of me. So I always heard about Janet Yellen. I had to take Tobin's course, and I had no idea what was going on for a while, and I got Janet Yellen's notes, and then it became clear what was going on. Anyway, if you read the newspapers, it's all about, is she going to raise the interest rate or not raise the interest rate? Or when is she going to raise the interest rate? Is she going to unwind quantitative easing or not unwind quantitative easing? That's all about the long interest rate. It was designed to keep the long interest rate low, too. So they're still talking about the interest rate. Now, if you think of economics, macroeconomics is all about the interest rate, what do you mean by tight credit? Everybody, every business person, even non-business people, they talk about tight credit. Credit's tight, credit's loose. Well, if you're serious about the interest rate, you must mean the interest rate's too high if credit's tight, or it's too low if interest rate, if credit is loose. But I don't think that's what business people mean when they say credit's tight or credit's loose. What they mean is, at the interest rate that's currently prevailing, credit is tight when they can't get a loan. And why can't they get a loan? Because the lenders think that they might default. So at the interest rate that you can read in the newspapers, they can't get a loan. And then we know interest is tight. So what was missing in the macroeconomic story was default. It just didn't appear in the story at all. So what I'm going to talk about is the possibility of default. And when you think of default, then very soon you can think of collateral. So the purpose of collateral is to make the lender feel more secure about the loan. So the bigger the collateral is, the more secure the lender feels. And of course, you have to take the ratio of the collateral to the loan. So that's called leverage. So the loan to value is the loan amount divided by the collateral amount. So for example, if you have a $100 house and you borrow 20 and you borrow 80 and you pay $20 of cash, you've borrowed 80% of the house. The loan to value is 80%. The margin or down payment is 20%, and the leverage, with $20, you managed to buy a $100 house, it's 5 times. Your cash, you got to sort of stretch it by 5 times. So all those words, the collateral rate is 100 divided by 80 is 5/4. They're all different ways of saying the same thing. It's a ratio, that key ratio, and you can look at it different ways. Now, one important aspect of leverage that I think every investor knows, including Shakespeare, by the way, is that if you're leveraged 5 to 1, say you have a house you bought with $80 borrowed and put $20 down, and the house goes up by $1, that's 1%, and you sell the house, you have to pay back the 80, so you end up with $21, but you only pay 20 down, so basically you've made 5% on your money. So the asset goes down $1, then you have 19 left, you lost 5% of your money. So leverage multiplies your risk, and that's the way all business people look at leverage, that's the way economics textbooks looked at leverage. That everybody knows. But beyond that, at least when I was a student, they never said anything about collateral and leverage. And I didn't take us, even in finance, you wouldn't hear very much about leverage or collateral, not to mention never in macroeconomics. So I changed the way I thought. So how did I think about leverage? Well, I decided in 1989 that I wanted to see what was happening on Wall Street. I was a mathematical economist. The most mathematical things in economics were being done in finance on Wall Street. And I decided to go to a little firm. It's not that little. It was the 7th biggest investment bank at the time, called Kidder Peabody. It wasn't Goldman Sachs, where most academic economists tried to go because it was a very academic, intellectual place. But I had a little cousin who had just graduated college and who was at Kidder Peabody, and he introduced me to the person who ran fixed income at Kidder Peabody. And that guy said, why go to Goldman Sachs and be one of 100 economists, in a corner working on some little option pricing problem? Come and talk to me, and you'll learn a lot more. So I went there, and I did learn more probably than or at least I was in the right place, it turned out. So Kidder Peabody, I was there for a while, and I was reading about mortgages. I didn't really know much about mortgages at all. I didn't realize what went on behind the scenes. I had no idea at the time that if you get a mortgage, the bank doesn't hold your mortgage, it sells it to somebody, and then they package it into these big pools, and they cut the pools up and stuff like that. It's a huge, complex operation, actually much more mathematical than anything else on Wall Street. So I picked exactly the right spot, and I spent a year there and had a good time talking to this guy, and at the end of the year, he said, I've learned from you that my research department isn't very mathematical. Why don't you run the research department from Yale? And hire me a new, actually he said, hire me a new research department. So I hired 25 people over the summer before I went back to Yale. Then he said, okay, you've hired the first 25, run the department from Yale. So I thought, my gosh, this might be interesting. I didn't realize what is interesting and also a little frenzied and a little more drama than I wanted. But I did it, and it turned out that Kidder Peabody became the center of mortgages in America and securitization. So there was a scandal in the mortgage department, and my little cousin, in his early 20s, got promoted to be the head of mortgages, collateralized mortgages, and he built it into the biggest mortgage operation on Wall Street. So we did 20% of all the mortgages on Wall Street. By the time he was 28 or so, he'd issued $500 billion, something like that, dollars of complicated mortgage derivatives. And Kidder Peabody was just booming along. And as I was seeing all this activity, everything around me was involved collateral. Every single deal they made, they'd say, oh, this guy might not pay us. What's the collateral he's putting up? When you get a mortgage, you might remember what happens is you get a mortgage, the bank buys your mortgage, so they feel safe because the house collateralizes it. Then they sell it into a pool, and the pool is split up into other pieces. The pieces are collateralized by the pool. Then the buyers of the complicated pieces, they don't pay for them by cash. They borrow most of the money and use the pieces themselves as collateral for what they buy. So there was collateral everywhere. Back and forth, I couldn't keep track of how much collateral there was, and I'd never seen it in any economics course. So I decided I should be writing about collateral equilibrium. So that was the first thing I did in 1997. Well, after 135 years, Kidder Peabody closed. It was one of the early scandals on Wall Street. It was a trader in the government bond department named Joe Jett. Some of you are old enough to remember this. And he'd apparently made apparently made $200 million the year before, but actually it turned out on closer examination, he'd actually lost $100 million. And so they fired him, and then he sued them for discrimination because he was Black, and so it was a huge scandal. It was on the front pages of the newspapers for an incredibly long time, and then suddenly General Electric decided to close Kidder Peabody, and I had to go back to my office at Kidder Peabody and invite the 75 people who worked for me in research and say, I'm sorry, you're fired. I'm sorry, you're fired. The 75th person left, and I went to the office next door, and the guy said, I'm sorry, you're fired. And so we all fired each other. 6,000 people got fired in one day. And I didn't realize at the time what had gone wrong, but the interest rates it was 1994, and the interest rates, which had been going steadily down, went up 8 times. And it was part of a leverage cycle, but I didn't realize, I had no idea what was going on at the time. So we decided to my cousin decided to found this hedge fund called Ellington. And Ellington was going to now buy the securities that he'd previously been creating. And our motto was, we created the mess, let us clean it up. And we didn't get too many investors with that motto. But we did make a lot of money because it was right after a crash. And it turns out that that's the best time to be an investor. Something else I was learning for the first time. So we were booming along at Ellington, and pretty soon we were doing so well, we began to attract a lot of investors, and things were going really well. And then one of our competitors was much bigger and more famous than us, although not bigger in mortgages, but in general, named Long-Term Capital. They went out of business. You may have heard of them. Founded by 12 people, including 2 Nobel Prize winners in economics. They almost destroyed the reputation of economics Nobel Prizes. But they went out of business, and we celebrated one of our best competitors going out of business. Well, a few months later, we got a margin call. So what does that mean? That means on a Tuesday morning, we got called, not Tuesday morning, on a Friday morning, we got called before 10 a.m., and we were told we had to produce a certain amount of money, a margin call. And if we didn't raise the money by 4 o'clock, then we would, our assets would all be sold that were collateral. And of course, if we've borrowed 80 and the assets are worth 100, they only need 80. They're not going to sell them probably as efficiently as we might. They probably only get 80 for them. And so this was a disaster for us. And we couldn't raise the money by the afternoon. And so it was big drama. We thought we're all going to go out of business. We had all these lawyers come in and tell us that, if you lose a little bit of money, you're a hedge fund, no one cares. You lose all the money, you'll be sued for incompetence or worse than that, and they might take your house. So we didn't know what we were going to do, and then my cousin decided that we would try to auction these assets ourselves over the weekend. It was Columbus Day weekend. So anyway, we ran an auction. We split it into 3 pieces, and the first piece, we auctioned them off. We just told people to bid, and we got all the bids in, and they were all 80. And that wasn't good. And so my cousin said, we're going to answer all the emails and tell everybody they were outbid. So we told everyone they were outbid. And then we auctioned the second third 2 hours later. We got all the bids, and they're at 95. And then they were at 99 the third time. So we survived to fight another day. But it was one of the most frightening experiences that I've been through. And so I thought, I mean, this is twice I've been in a place that's nearly gone out of business, and I've thousands of people the first time, and not quite so many the second time, could have been fired, and it can't all be my fault. I was in charge of making the models. Maybe it was all my fault. But anyways, it can't all be my fault. There must be something systematic going on. And that's when I tried to think of the leverage cycle. So I presented the leverage cycle in the 2000 Econometric Society meetings. That's what I'm going to tell you about. Anyway, Ellington boomed after that near crash, because after a crisis, it's the best time to be an investor. It boomed until the next crash in 2008, into 2007, 2008. And again, we teetered on the brink, although not quite as bad that time, and we survived. Again, almost very similar story. And I learned something new, which was forgiveness, which I hadn't thought of before, really, very carefully. And all these homeowners were defaulting, and they were being thrown out of their houses, and the lenders were getting almost nothing back. 20 cents on the dollar they were getting back. If they forgave the loan, they could have done so much better. And so I testified twice in Congress about forgiveness. 17 hedge funds wanted to forgive debt, like our hedge fund. They asked me to represent them all, but I thought it'd be better to speak as a Yale professor about forgiveness. But anyway, the 17 of them got someone else to represent them and said they wanted to forgive debt. And I said it was the right thing to do. And of course, we didn't do it. Not a single penny of subprime debt was forgiven. But I'm going to come back to that story next lecture. Now, I gave the graduation speech at the University of Athens Economics and Business School. And I talked about forgiveness, and I basically said that, we should have forgiven debt in America, and that would have gotten us out of our crisis. The only solution to the Greek problem is to forgive debt. I think it's going to happen, because how could it not happen? And your families, you won't have to grow up and leave Greece like my grandparents did to find opportunity. The debt will be forgiven, and there'll be opportunity again in Greece. So one of the professors there turned out to be later the Minister of Finance. And although he probably didn't believe a word I was saying, he asked me to help him with the debt negotiation with the Troika last year. So I'm going to talk about that as well next time. So that's how that's how the idea came to me about the leverage cycle. So what is the theoretical idea of the leverage cycle, the key idea? It's that when people can leverage more, the asset prices go up. It's as simple as that. Finance was caught in the throes of efficient markets, that every asset is priced by a rational calculation of the dividends it'll pay. And the market susses out what's going on and figures out the fair price given what the market knows and what everybody knows about potential pitfalls and what the dividends can be. But I was saying it doesn't matter. I mean, it matters what the dividends are, but beyond that, if you take two assets with the same dividends, but one of them can be leveraged and the other can't, it's going to sell for a higher price. And similarly, if it can't be leveraged, it'll sell for a lower price. And that works not only on the scale of a single asset, but on the scale of the whole economy. And the reason is very simple, that if you going very slowly. The reason is very simple, that if you have a bunch of buyers and you order them according to who's the most optimistic and who's the least optimistic, the price is going to be equal to somebody's opinion, say the marginal buyer. So what happens if you can leverage more? Well, you need less people to buy because they can each get their hands on more money. So the number of buyers, the people above the marginal buyer, are the ones who think the price is good. They're going to be the buyers. The one below the marginal buyer will be the sellers. If people can leverage more, you won't need as many buyers. So that group of buyers can shrink, which means the marginal buyer is higher. But the marginal buyer's valuation is now a higher person, and that's the price. So the price has to go up. It's as simple as that. And these people who can differ for all kinds of reasons. They can be differ in risk tolerance. They can differ in ability to hedge. They can just like the asset differently. So some people like houses, some people don't like houses. They can be more productive on the farms than other people. Some people can just be more optimistic than others. There's a variety of reasons why people would differ and why you shouldn't expect everyone to have the same opinion. So the second key idea is that leverage is going to depend on volatility. What could be more obvious? The more dangerous the world is, the more insecure the lenders are going to feel, and the less leverage they're going to permit. So the leverage cycle basically works like this. You start with price of assets, and people can borrow, say, 80%. Time goes by where volatility seems very low, the world seems safe, everything's going well, and meanwhile there are people like my cousin doing these innovations on Wall Street to stretch the available collateral. That's what these collateralized mortgage obligations were all about, stretching the available collateral. Use the same house as collateral many times. So with innovation and people feeling safe, the amount you can borrow goes up. But when the amount you can borrow goes up, the price goes up. And now you can borrow a higher percentage of a higher number. So you can borrow a huge amount more. So here the world looks wonderful. Everything's gone up. Everybody's feeling safe. Things are only going up. But the economy's at its most vulnerable because everybody is stretched so far. So when a little piece of bad news comes and the price goes down, and now maybe it's underwater a little bit, some people are going to lose money. But who's going to lose the most money? Well, it's the leveraged buyers. And remember, if you're leveraged 5 to 1, you lose 5 times the fall of the housing price. If you're leveraged 30 to 1, you lose 30 times the price of the housing price. So the most ambitious buyers, the most opportunistic, optimistic buyers, they're the ones who are leveraged the most. They're the ones who lose all the money. So because of that, their demand goes away. They're forced to sell, and the price goes down even more. But now the lenders say to themselves, well, the world has changed. It's more dangerous than it was before. We're not going to lend at that amount, that leverage of 95% or something. And so the new buyers who want to buy, maybe they're not as optimistic as before, but they can't even borrow the money to buy. So the new buyers really are constrained, and the price falls even further. So at that point, if the gap gets big enough, the debt is here and the asset values are here, that's the calamity. But it's a double calamity because you're never going to get paid. So if you insist on squeezing as much money as you can out of the homeowner, you're going to end up with less than you would otherwise if you forgave part of it. And that's the idea of forgiveness. So the Fed, what should the Fed do? It should prevent the leverage from getting so high when it's going way up. And when things are going down and nobody can borrow, the Fed should step in and make borrowing easier. And it should help with forgiveness. That's my basic theme. So, glad you, well, it's a Santa Fe theme maybe. But now here's some evidence for it, and then I'm going to elaborate it a little bit. So it seems to fit the data pretty well. So what I have here is a chart that Ellington used to keep before anybody was thinking about collateral, and we were. And the blue line is the loan to value that we had to pay, or would have had to pay, the maximum loan to value we could get on a basket of securities that we were typically interested in buying. Not that we would leverage that much, but that's what they would allow us to leverage. So you see it's at 90 on the left-hand side, and then it suddenly drops to 60. That was the 98 crisis I told you about, which is what made me think about the leverage cycle. But that blip came back very quickly in a few months. Everybody said that the lenders were just panicked and crazy for changing margins so drastically. And we thought, but I thought maybe they weren't so crazy. Maybe the world that happens every now and then, margins suddenly change. So you can see that margins are adjusting. Now the red is the price of these securities. These are bonds that are floating, and so the price doesn't need to change unless you're afraid it's going to default. So you can see that leverage goes up there in 95 or so, goes up to 95%, 20 times leverage, and then it starts to drop. Everybody gets a little scared about the uncertainty. And look at what happens to the asset prices. They plummet just with leverage, and then they both go up together. So it's a remarkable fit, but of course it's really only 2 or 3 points because everything else, but it's quite an astonishing parallel. So then let's take another example, the housing prices. So the blue line, or the green line, is housing prices starting in 2000. It's the Case-Shiller Index. And as Shiller was fond of pointing out, housing prices went from 100 to 190, 90% in this index till 2006. That's where it hits its peak. 90% in 6 years. It's incredible. It's almost unheard of, he said. It's crazy. These people are irrationally exuberant. They must be telling each other things can't do anything but go up. And so he actually predicted that things had to turn around because things had just gone up too high. He said they were crazy. Well, they probably were crazy, some of these homeowners, but they weren't completely crazy, because if you look at the loan to value, so these are all the non-government loans, of which there were half were non-government loans in this period, and it's the average loan to value or down payment, I've written it as down payment, that the 50 percentile guys put down. So in 2000 it was 14%. In the same quarter that housing reaches its peak, the down payment goes to 2.7%. So you went to almost 40 times leveraged from 7 times leveraged. And then you see that leverage collapses. I'll explain why tomorrow. And then you see that the housing prices collapse too. So Shiller would say the housing prices collapsed because the narrative changed. People started saying, oh, I can't keep going up forever. Something must be going wrong. And so people said we better sell before everyone else sells. I'm saying something was going wrong, and it was very hard for a new buyer to get a loan. Okay, so take just a little bit more evidence. So here is the loan to value, or the debt to income, household debt to income in a bunch of different countries in 97 and 2007. So you see Italy goes up a lot. You see Spain in the middle goes up a lot. You see Ireland on the end goes up a tremendous amount, and Norway up, and the US goes up, and England goes up, from the gray to the red. But you see in the middle, Japan, it's actually gone down, and Germany next to it, it's even gone down a little bit. And then you see what happened to you have leverage on the horizontal axis, whose leverage went up the most. In the vertical axis, you see whose housing prices went up the most. There it is, Ireland at the top, UK, Spain, Norway, all those countries, Denmark, we said. And there at the left, no leverage, no increasing housing prices, Germany and Japan. Then you ask what happened after the crisis, who lost the most? Well, Germany and Japan lost the least at the top left, and there you are with Ireland and Spain at the bottom right. Okay, now another idea that's going to emerge in the leverage cycle is the credit surface. So if you ask how much interest you have to pay depending on what your loan to value is, if it's a very small loan to value, the lenders are going to feel perfectly safe, and you're going to pay sort of the riskless interest rate. So the loan to value starts to go up. The interest rate is eventually going to start to go up, and go up quite sharply. So this picture answers the puzzle. What does it mean for tight credit? What does it mean that credit is tight? It doesn't mean that the interest rate at the riskless one is too high. It means that it goes up too fast. It's too steep. The most interesting borrowers probably are the ones who are, might default, and so they're going to pay a high interest rate. And so their interest rate might be going up a lot, even if the riskless interest rate isn't going up at all. So that's the definition of tight credit, a steep credit surface. So this is not anything a practitioner wouldn't be aware of or think of. It's just that somehow it isn't pictorially captured. So I got a graduate student to do the credit surface in 2013 of all the Fannie and Freddie loans. So on the left axis, you see LTV. So on the back, it's 100. In the front is low LTVs. On the right is something else that's going to play a role. It's called FICO, or credit score. It's true in corporates. In individuals, you might know your own credit scores. It's actually shocking how low they can be if you're just a little bit late paying things. But anyway, the credit score on the right is 800 in the near term. That's a very good credit score. It can even be slightly higher than that. And it goes down to 650 in the back. But look at the interest rate. So these are the best borrowers in America. They're Fannie Mae, Freddie Mac, conforming, borrowers who are allowed to enter those programs. This is middle America. And even for them, the interest rate goes from 3.8% for the good people in the near term all the way up to 4.6% in the bad term. So that, I think, captures the credit situation in the economy. And as we're going to see tomorrow, that curve can be, that surface can be very steep or very flat. When it's steep, it means credit is tight. When it's flat, it means credit is loose. And it can be a different picture depending on what the collateral is. So there should be well, I'm going to show you, there's a corporate credit surface and a mortgage credit surface and a consumer loan credit surface. And if we could keep track of those, if the Fed would be producing these every quarter, like my student did, the Fed is now working on this, we would have a much better picture of what's going on in credit and what the central bank should do. So the leverage cycle, as I said, when things are getting better and volatility is going down, credit standards loosen, that pushes things up and gets everything going better again. And you keep going round and round where things get better and better, but then something bad happens and you start going round and round in the other direction. So, okay. So my recommendation that you're going to see tomorrow is that we should be keeping track of these credit surfaces, and the Fed, when it's deciding what to do, should have in mind if we lower the rate, we're going to move the credit surface down, maybe not even in parallel, and we're going to move the corporate credit surface and not the mortgage credit surface. And which one do we want to move? Quantitative easing, they bought mortgages, they didn't buy corporate. So anyway, so that's going to, I'll leave that for tomorrow. Okay, so that was my idea, which I'm going to elaborate. But I want to tell you now a little bit about the history of this. So I'm going to first mention Shakespeare. So the Merchant of Venice that you've all heard of, and you're of an age where you might have read it, although the young people today, apparently it's not regarded as one of Shakespeare's great plays anymore, so it's not read so much. But in my youth, everybody read it. It was regarded as one of his great plays. And it was supposed to be a comedy and a love story. But actually, it was about the leverage cycle. So, the play opens, many of Shakespeare's plays open with him telling you what the play's about. So it opens with the Merchant of Venice, Antonio, going on stage, and he says, "Forsooth, I don't know why I'm so sad, I'm so melancholy." And the other guy says, "Well, it's obvious you've got all your boats on the oceans, and it's so risky, you must be scared to death." And he says, "No, every boat's on a different ocean. I'm not worried at all. That's not it." And then the guy says, "Well, you must be worried about love." And he says, "No, I'm not worried about love." So you see, Shakespeare's announced at the very beginning that although people think it's a love story and a comedy, it's really about business first and love second. And not only that, but he understands diversification. So what happens in the play? Bassanio, the hero of the play, he wants to marry the rich Portia. We find out she's rich before we find out she's beautiful, which of course she also is. He wants to marry Portia, but he doesn't have the money to go woo her, so he needs to borrow it. And Antonio doesn't have any money because it's all tied up in his boats. So they have to go to Shylock, the Jewish moneylender, who's willing to lend the money. And they have this tremendous debate about what the rate of interest should be. And Shylock, Antonio says basically, if you were Christian, you would understand you shouldn't charge interest, and it's just terrible that you want to charge interest. And Shylock explains what basically is today the modern theory of impatience theory of interest, which Shylock says, you're impatient, you really need the money in a hurry. I'm willing to wait. That's why you need the money from me now, and that's why you're willing to pay interest. And so, I'm willing to give it to you if you pay me enough interest. So they go back and forth, biblical references and stuff, 5 pages about what the rate of interest should be. Then they negotiate the collateral. Now, I saw The Merchant of Venice with, what's his name on Broadway? Al Pacino, thank you. And I walked out with a whole bunch of people in the audience, and I said, "Can you tell me what the rate of interest was that Shylock charged in The Merchant of Venice?" Not a single person. Even they'd just seen the play. They couldn't tell me. I don't know if you could tell me, much as you've probably read it. Not a single person could tell me. Shakespeare realized the rate of interest isn't the key variable here, it's the collateral, and everybody can remember the pound of flesh collateral. He made it more dramatic because it's more important. So he understood it was about the leverage cycle. So what happens to the loan is that the boats, apparently of Antonio, have all sunk. And so now they're not going to be able to pay back the loan. And so Shylock makes a margin call. He says, I want my money. They say, why don't you just wait for the boats? He says, I want my money. You promised me the money. I'm owed the money. And so they have a trial. And Portia, who's so rich, who's by this time married Bassanio, she's so rich, she makes a deal with the judge, maybe pays him off, and disguises herself as the judge. So she says, Shylock, can't you be generous? Can't you show mercy? And Shylock says, mercy's irrelevant here. We made a deal, it was a contract, it was freely agreed on. Venice has to enforce contracts. That's what makes commerce run. If you don't enforce this contract, you're going to destroy the city. And she says, well, you're very right, Shylock, that commerce does depend on enforcing contracts. But sometimes it's so important that that it's possible for the judge to intervene. So the court intervenes and changes not the interest rate or the loan amount or anything like that. She changes the collateral. It was a pound of flesh, but not a drop of blood. They didn't say not a drop of blood. It was clear what they agreed. She adds, but not a drop of blood. And once they've changed the collateral, he can't get his pound of flesh, and so he doesn't end up getting his money. And so Bassanio rushes up and says, oh, noble judge, you're so wonderful. Can I reward you for that great judgment? She says, I don't need a reward. He says, oh, please, let me reward you. And she says, well, you see that ring you're wearing? I'd like that. He says, oh, no. I just got married to the fair Portia, and she gave me her ring, and I promised I'd never give it up until I died. I can't give you that ring. And she says, is it important for you to reward me or not? Did you say you wanted to reward me? I want the ring. And so he gives her the ring. And so he's supposed to be a complete fool. And I went to Harold Bloom, Yale's greatest Shakespeare scholar, and heard his lecture on The Merchant of Venice. And he said, Bassanio's not going to last 6 weeks with Portia once they're married. But in fact, there's another scene where he sees Portia, and she embarrasses him, asks him where the ring is and stuff, and finally he confesses all, and she forgives him. Of course she forgives him. What else could he do? Something unexpected happened, something incredibly important happened, and he decided he had to break his promise, and he did. Okay, so Shakespeare's anticipated the forgiveness. Now, what else did all these people say for 1,000 years? All of it was about the same things I'm talking about. So and what are the things I'm talking about? When you talk about debt, you have to talk about default, you have to talk about punishment, you have to talk about collateral, you have to talk about restraining borrowing. And that's what all these philosophers were talking about. So we have the Code of Hammurabi, and in that code, it was written on what do you call it? What's it called? No, slate. There was slate. It was slate, and there was marked, how much everybody owed everybody. And there was also, we've got the slate tablets of what was owed. We've also got the code that says if you don't pay, what happens? Terrible things can happen. You can be enslaved, your children can be enslaved, etc. So grave punishment for defaulting. So, but also in the code, it says if you agree to an explicit collateral, like your house, then they can't enslave you if you default. They just take your house. And not only that, Hammurabi, like several of his predecessors, he forgave the debt. There were so many people in so much debt that it was important to forgive it. And they all started with a clean slate. That's where the expression comes from, as you probably know. So the Greek Draco, the first person to write down the laws of Greece, said, if you default on a loan, you'll be killed. Or put into slavery. Sorry, you'll be put into slavery. Other things you could be killed for. So these were draconian punishments. He said, well, they're draconian, but that's what they deserve. If I could think of a worse punishment than murder, than killing them, I'd do that. But since I can't think of anything worse, so they're all, so that's where we get the word draconian from. Well, he was succeeded eventually by Solon the lawgiver, one of the 7 sages of Athens. And he had lots of pithy sayings. One of them was that the best in life is to grow old, forever learning new things. Just before he died, he memorized a new poem because he wanted to know it, carry it with him. So he repealed Draco's laws, including the enslavement for default, and he allowed people to use their farms as collateral, which Draco had forbidden. He also decreed a debt forgiveness, and he had discussed this with 5 of his friends who immediately went out and took big loans, and then he announced a debt forgiveness. So they knew about moral hazard back then, too. So Plato's in the Republic, which is a book about justice, his first definition of justice is keeping promises. And what does he discover? So that's what they propose, and Socrates debunks it. He says, well, you can't always keep your promise. Maybe the person you're supposed to, maybe things have changed, something unexpected happened. You might have borrowed a knife from someone. When it comes time to return the knife, the guy might be crazy. You shouldn't return the knife in that case. So keeping promises can't be an ironclad rule of justice. Aristotle, by the way, thought interest was barren, and you produce something out of nothing, and it's not natural, and so no interest should ever be charged. So the Romans, I got to move quickly here, the Romans also enslaved people, and they also had to forgive them every now and then to raise an army. If there were too many people and too much in debt, they couldn't raise an army, so they had to forgive them, and Caesar himself promised to forgive the debts of his soldiers if they fought against Pompey. The Egyptians had the same kind of, they banned enslavement. And the Rosetta Stone, now all of you probably know of the Rosetta Stone. It's the most visited object in any museum in the world. More people visit the Rosetta Stone than visit anything else in London. So the Rosetta Stone is so famous because it's got hieroglyphics, Demotic Egyptian, and Greek. And since we know Greek, we're able to decipher hieroglyphics and Demotic Egyptian by having the Rosetta Stone. That's why it's so famous. But nobody seems to ask, what was so important that they had to write it in 3 languages? Well, it was forgiving debt. Ptolemy V was forgiving debt. So people were setting interest rates left and right. Everybody knew debt could lead to trouble. In Judaism, they had the 7 years forgiving of debts, the 50-year jubilee of returning, everything, freedom, property, everything every 50 years, and they had laws about not lending. To quote Leviticus, if your brother becomes poor, take no interest from him. In Deuteronomy, thou shalt not lend on usury to thy brother, usury of money, usury of victuals, usury of anything that is lent upon usury. Usury is interest. Unto a foreigner thou may lend on usury, but not to a brother. Okay, Christianity, St. Basil said interest was terrible, and people being in debt, they ended up in jail and lost their children, was a horrible thing. And so in the Council of 325 AD, they forbade lending at interest, and in 1197 it was called declared a mortal sin. Islam forbids lending at interest. So everyone's realized there's a problem. So, of course, everyone did lend at interest, even though it was forbidden. It happened all the time. Luther thought interest was terrible, but he had a change of heart in 1524. And Calvin said, maybe lending at interest, if it's low enough, isn't such a bad thing after all. So in 1545, Henry VIII legalized lending at interest, just at the time of Calvin, but set a maximum of 10%. They went back and forth, ended up getting lowered to 6%. But debtor's prison was emerging. And you probably know that there are several famous people writers who've gone to debtor's prison. Daniel Defoe wrote Robinson Crusoe, owed 17,000 pounds and went to debtor's prison. And this was in 1692. And he managed to get out after a year because his creditors figured he might be able to pay them if they let him out. The father of Charles Dickens, John Dickens, also went to debtor's prison. He got out in 3 months, and this changed Dickens' life. And he writes constantly about debt and debtor's prison, and David Copperfield is almost about the story. But John Dickens actually got out after 3 months because his mother died and left him a big inheritance so he could pay his debts. But anyway, Daniel Defoe crusaded against debtor's prison. Nietzsche, in the Genealogy of Morals, said actually conscience grew out of debt. Conscience and debt are the same word, schuld, at least an archaic word for conscience. And so what happens, he said, after thousands of years of being horribly punished for not paying your debts, people began to feel bad about not paying them. They developed a conscience to protect themselves. Their conscience wouldn't let them not pay back, then they wouldn't be boiled in oil. In fact, people even got to like seeing people punished for not paying back. So I'm going to come back to this when I talk about Greece. And so anyway, I won't go on. So the Bank of England, okay, so the basic Federal Reserves and banks were created in order to manage interest and prevent calamities that are arisen. But in all these cases, you see people are talking about the same things that I said. And everybody had these usury laws that gradually disappeared. In the US, the states had them. And what happened, there was a Supreme Court ruling in 1978 that a bank that opened in a different state could charge interest of the new state. If the bank was located in state A, it could lend in state B using A's interest limit. So therefore, you could go to some state like Minnesota or Wisconsin, I forgot which one it was, that charged, had a high debt limit or interest limit, and you could open branches everywhere else charging high interest. So this made the states compete against each other, and so it sort of did away with the usury laws. And then there was a huge inflation in the late 70s and 80s, and that made them, many of the states raised their usury laws. Okay, so I'm going to come back now to the leverage cycle, but I want to mention some alternatives. So what do people say after the crisis? Now, I developed this theory before the crisis. I think a lot of people have come to believe in the leverage cycle. Maybe they came to it independently of me, too. I think there's some sense to it, but it's not like it's the only theory out there. And I want you to be aware of other alternatives. So one of them is held by many people. Kindleberger was the most sophisticated. He was an MIT professor who had many anecdotes. And basically what he said is what happens in these booms and busts is there's some opportunity, something gets invented. There's some reason why people think the time is different, and there's now a great opportunity there hasn't been for years. So the prices of things start to go up. Now they start selling this stuff and misleading people about what they're really buying, so they're swindling them too. On top of that, when the prices are going up so much, people figure, well, I better get on the bandwagon so I could buy, and I can make money too. And on top of that, Kindleberger said, it seems curious, but every time this happens, the interest rates are low, and it seems to be easy to borrow money. So then what happens is people realize that the opportunity wasn't so great after all, and they all realize they're wrong, and the thing crashes. So then Minsky, he was before Kindleberger, he had a theory that had a little bit to do with leverage. He said that there are three kinds of borrowers. There are people who borrow, business people who borrow, and everything they have to repay, they can repay out of the profits they make every year. Then he said when people get a little bit more speculative, they borrow the interest they can pay out of their profits, but the principal they can't repay, so they have to count on rolling over the debt. They have to count on profits persisting for a long time so they can keep rolling over the debt. And then they get really optimistic and they start borrowing so much that even, if the current profits, even if they went on forever, they'd never be able to pay off the debt. So as people get more and more diluted, they move from what he called a hedge borrower to a Ponzi borrower. And then one day they all wake up and they say, oh, this was a drastic mistake. We're all wrong. There's really, they can't pay this off. And so the price of the firm's not going to go up, so we'll never be able to pay the debt, and everything collapses. Okay, so that's similar to Kindleberger a little bit. Now there's one other theory, and this is the one that's held by everyone in power. And it starts with a bank run theory. So the explanation of bank runs, I think, is very believable. You have the depositors in a bank, and they all think to themselves, if I take my money out, does the bank have enough assets to pay me? And they have to not only worry about pay me, but about pay everyone else. Because suppose that the assets that the bank holds, maybe in the long run they're worth a lot, but if they had to sell them very quickly, they wouldn't be worth very much. So somebody might say, a panic might arise, because someone will say, I think in the long run the bank is fine, but in the short run, all these other guys are going to take their money out. The bank will be selling things off to pay them. Pretty soon there'll be nothing left for me, so I better ask for my money too. Then they all ask for their money, and then the bank really is in a terrible fix and has to sell stuff and can't pay them back. So that story of multiple equilibria. If everybody is patient, there'll be plenty there in the end. But if they think the others are going to take their money out, they have to run too. That idea of multiple equilibria, that's the basis of the sort of banking lender of last resort. Because if you can step in and lend to the bank or buy the bank's assets, you can stop the panic and save the bank. And that's what central banks are supposed to do. So it's a multiple equilibrium story. But another way of saying that is you have to restore confidence. And that's what that's what everyone in power always seems to think. So Geithner, who was the Secretary of the Treasury during the crisis, he wrote a book called Stress Test. Well, that's the title of his book. What did he mean by that? He invented the stress test, which was meant to show in a stress situation would the bank survive. And once the banks passed those tests, everyone was assured that the banks were fine. Of course, the tests, in my opinion, were doctored in such a way that the banks were going to pass. But anyway, the stress test was what gave confidence to everybody. Bernanke's book, the head of the Fed, Courage to Act. So again, to restore confidence. So they think there's a multiple equilibria. If they can just assure everybody nothing's going to go wrong, the panic will stop and everything will stop. Everything will be okay. So they had to do all sorts of things, buy all kinds of stuff to restore confidence. So my story, I think there's some truth to all those stories, Kindleberger, Minsky, and this bank run story. But we have deposit insurance. There really isn't runs on banks anymore. They must be talking about runs in America. There is in Europe runs on banks, but not in America. They must have been talking about runs on money markets and stuff like that. But they got a little confused, I think, because they started talking about runs on collateral. The difference between collateral and a bank is it's your own collateral. It's if I'm a lender, that one house is my collateral. If I think that house in the long run is going to be worth plenty of money, there's no reason why I should panic now. No one else can take that house away from me. It's not going to disappear. Maybe the housing prices are falling, but eventually that house is going to have a good value. There's no reason why I should panic. So the bank run story depends on this first come, first serve, and everybody's trying to get into the same pot. That's not true with collateral. Anyway, lots of people around the time I started writing about collateral, including Bernanke, also started writing about collateral. So I'm not the only person who wrote about collateral in '97. But the others didn't write about leverage, the changing leverage, which was the key thing. Okay, so what I want to move to now is explain the mathematics of the leverage cycle, and I seem to be running out of time. So I'm going to spend, I guess, 5 or 10 minutes on this, and then I'm going to have to leave it till next time and rethink what I'm going to say. This is going to be the main part of the talk. Today, you might ask the question, how is it that mathematics is helpful at all in economics? Why shouldn't it be helpful in every social science? Why just in economics? Well, one obvious answer is that there are these easily measurable things, price and quantity. And not only that, you can multiply them together. So there's a mathematical operation at the basis of it. Now, when did economics start to become mathematical? It was because of a financial crisis. So in 1929, there was the stock market crash, and there was a guy named Alfred Coles, and he was part of the very wealthy and famous Coles family. They were in media. And his job in the media empire was to run a macroeconomics forecasting company. So every week he would say, buy these 4 stocks. Every week he had 4 stocks that people were supposed to buy. And the day before the crash, he also told people they should buy a bunch of stocks. And he was very embarrassed that he hadn't noticed anything about the crash. And so he went around and read every other forecasting thing, and they all were the same. They were just as bad as he was. So he decided it was all a fraud. Economics was a complete fraud, and it should become mathematical. And so he went to his father, and they decided to start a mathematics institute, but they didn't know how to do it. So they went to Irving Fisher, who was his Yale professor. Alfred Coles was a Yale undergraduate, and asked him what to do. And Irving Fisher said, yes, you should start an institute. But we also should start a society. We'll call it the Econometric Society. We should start, it's the most famous society in economics now. We should start a journal. We'll call it Econometrica. It's the most famous journal in economics now. And we should start a commission, the Coles Commission, where people who do mathematics can come to do economics. So it was like, it's interdisciplinary and mathematical. It's like the Santa Fe Institute, you might say. And so one of the most important members of the Coles Foundation was Kenneth Arrow, and he's there in the middle. So there he was last year in November and at Columbia University, and he came because I was giving the Coles, not the Coles, the Arrow lecture at Columbia, where he'd been a graduate student, and he's there with his, to his right is a classmate of mine, Takatoshi Ito is one of Japan's most famous economists, and he also happened to be visiting New York, so he came to the talk too. So this was just before Arrow died. I had no idea he was so sick. He was the discussant of my talk, he and Stiglitz. He gave a brilliant discussion at 95, and then a couple months later he died. So I thought it would be an interesting thing to talk about what it is that Arrow did. And so I'm going to spend 5 minutes talking about what he did, and then I guess I'll have to stop, because this was going to lead to what I did. But well, I'll save that for next time. So what did Arrow do? How did he make economics mathematical in a way that hadn't been done before? Well, you could imagine people in this theater trading 4 goods. Those are the 4 goods sitting there, and you each might own various amounts of those 4 goods, apples and oranges and pears. They're for fruit. You like fruit differently. Someone who has apples might want pears instead. So what would happen if you traded? Well, you might scream out offers back and forth, and all pandemonium would break loose. So someone in 1874 called Walras, he said, equilibrium will arise, general equilibrium. There'll be method to what's going on, and even though everyone's screaming and yelling at each other and it looks so confusing, it in the end can all be described very simply as part of general equilibrium. So what is general equilibrium? Well, this reminds me of a similar question. What is Nash equilibrium, which is very closely related? And after, you may have seen the movie A Beautiful Mind by John Nash, about John Nash, great mathematician and one of the creators of game theory. And so right after the movie, they decided, wouldn't it be wonderful to open the Indian Game Theory Society and have John Nash be the featured speaker? And they invited a few other people like me to come and speak as well. So in fact, thousands of people came to hear Nash and basically left before any of the other speakers could talk. And afterwards, Nash was with his wife too. We went on tour of India, and every city we went to, there was a conference, with reporters. And the first one we went to, a reporter says, could each of you speakers, could you say in a word, what is game theory? What is Nash equilibrium? So everybody tried to give a definition of Nash equilibrium, me and Nash, and the last person to speak, it so happened, was this guy named Robert Aumann, and an Israeli game theorist. And he said, that reminds me of when Nikita Khrushchev gave his first press conference, the old premier of the Soviet Union in the 1960s. His first press conference open to Westerners. And someone said, Mr. Khrushchev, can you describe in a word the health of the Russian economy? And he said, good. And the reporter said, okay, take 2 words and tell us about the health of the Russian economy. He said, not good. And so Aumann said, Nash equilibrium in 1 word is interaction. In 2 words, rational interaction. So that's what equilibrium is. And what happens is prices emerge. So in equilibrium, even though everyone's screaming about the prices, it's as if everybody knew the prices in advance. It's just the price of everything somehow magically gets set, and people buy and sell all they can at those prices, where they sell what they have and they buy what they want, given that they only have income from what they sold. That's the definition of equilibrium. And Adam Smith described, the economy with the invisible hand, that people without any desire to make things better, they're just pursuing their own selfish interest. They make things as better than they would if they tried. So, all right, so taking me longer than I thought. So how do you make all that mathematical? That's what Arrow did. He made that mathematical and so simple, and he basically showed that, the first thing he showed was that if you look at the trading that happens when everybody trades and look at their final allocation, you call it Pareto optimal if there's no way to make everybody better off. And then he proved that in equilibrium, the final allocation will be Pareto optimal. The market somehow will discover the right way to allocate things, distribute things, so that it couldn't be improved, even if you were the central planner and knew everything. And his proof is just a few sentences, which I don't have time to give. People had tried for years to explain it, and pages and pages of mathematics, and he did it, and that's the whole proof. That's the whole proof. Okay, if there's another allocation that makes everybody better off, each person must think that new allocation was more expensive than what he ended up with. Otherwise, he wouldn't have chosen what he did. But if this new allocation cost more for everybody, then it couldn't be feasible, because the total cost of it is more than the total cost of what's there in the economy. So it wasn't feasible, this supposedly better allocation. That's it. And then the last thing he did, the second thing he did that was quite stunning, was he said, does equilibrium exist? So, just a second. So lots of people tried to do this. The first guy, Walras, who described the equilibrium, he said, look, equilibrium is if there are L commodities, you just look at demand equals supply for L commodities. And if you start with the wrong prices, there's too much demand in one good, you raise that price. If there's too little demand in another one, lower that price, you'll get to an equilibrium. Well, that's no proof of anything. There are many equations that don't have solutions. You can move around however you want, you won't get to a solution. But the economic equations always do have a solution. And von Neumann, Wald, lots of famous mathematicians were unable to prove it because they didn't quite get the details right. And Arrow, De Bruijn, Mackenzie, 3 people simultaneously did prove it. And so, anyway, those are the 2 things he did. And he started, so the economic system works well, but if it works so well, how do you get crashes in finance? What's going on? So Arrow also pointed the way to how to do finance and how to, study so many more things. And he did it with a sleight of hand. Okay, this is the last thing I'm going to say. So if you've got time, there was no time. Finance is all about time. So suppose you've got commodities today and commodities tomorrow. So there are 2 sets of markets. We're trading today, and then we're going to trade tomorrow. Well, Arrow said, why not trade all at the same time? Now you've just got 8 commodities instead of 4 and the same prices. It's like trading an apple today for an apple tomorrow. And then people said, so you don't have to change anything. The market, if you could trade all those things, would do perfectly well. And in fact, trading an apple today for an apple tomorrow, the relative prices of those is like the interest rate. How many apples today do I give up? If I give up 1 apple today, how many apples do I get tomorrow? That's just what the interest rate's like. So trading commodities is just like finding out the interest rate. Okay, this was actually already thought of by Hicks and Irving Fisher himself. But then Arrow took one more step, and he said, how do you put in uncertainty? Before him, everybody thought of uncertainty with normally distributed variables, very complicated stuff. And he said, well, it's much simpler than that. Think of an apple in New York on January 1st, 1953 as a different commodity from the same apple in New York in 1953, depending on the weather in Paris. So you now have many states of the world. So how does this capture what's going on in the world? Well, you don't know what's going to happen tomorrow. Many different things can happen. But you can describe a stock now as something, you can describe a stock, now these yellow things are stocks, as its payment in each of the different states. And you can define an insurance contract as what it pays in the different states. So all these things, stocks and insurance contracts, they're like basket of fruits. If you could trade all these goods just like you were trading the fruit before, an insurance contract or a stock is nothing other than a basket of fruits. If you know what each of the fruits are worth, you know what the stock is worth or what the insurance contract is worth. So as long as you can trade all the goods, that's the ideal world, then the market's going to solve every problem, and you'll be able to price all the assets and price it by figuring out what the price of those single fruits are, the Arrow securities they're called. So though that invention is, finance people after that started talking about state prices. The prices of payoffs in every state, that gives you the prices of the assets. They talked about spanning. Once you have the prices of all these individual fruits, they add up to the basket of fruit. So that's how you can price the basket. And there's no arbitrage. All the words of finance came out of that. But the key problem was that he assumed you could trade all the commodities at time zero? What if you can't trade all the commodities? There are only a few number of stocks you can trade. Okay, so that was where he stopped and where I'm going to pick up. And I want to, okay, so I was going to explain where all this, where all my concepts, the credit service and stuff came from, and so maybe I'll try to do that in abbreviated form next time. But what I'm going to do next time is I'm going to give a very abbreviated form of how I thought of the theory and how it relates to this simple framework, so you can see where the credit surface came from and all that. And then I'm going to describe what happened in Europe and America and try to show that it conforms to the leverage cycle and that we did all the wrong things. We could have done so much better than we did do. I mean, we've come out of things now pretty well, but it's been almost a decade later. We wasted so much time that we could have done better. So that's what I want to talk about next time. So I'll stop here. So I'm happy to take a couple questions.
Okay, I have one over here.
So does Pareto work when monopolies manipulate the prices?
Oh, you're asking. Sorry, I thought I didn't hear the question. Though.
Does Pareto work when monopolies manipulate prices and markets?
No. So the question was, in this in this world of being able to trade every potential contingent commodity, that's the idealized world where all risks can be traded. What happens if there are monopolies? Well, that causes a problem. So you have to have a lot of competition in order to get to the idealized world, and you have to have this ability to write every insurance contract, trade every state contingent commodity. And the question is going to be, so I'm not going to ask the question, what happens with monopoly? I am going to ask the question, what happens when you can't trade every state contingent commodity? Yes?
Second question over here.
Low volatility in financial assets, very low volatility.
Yes.
At the same time, if you look at American, if you look at American corporations, because of low interest rates, the people who could borrow had leveraged the balance sheets up quite a lot. So are you really saying that kind of a black swan event is going to occur because people are confident now, so they're borrowing now? And the financial markets are saying, well, everything's just hunky-dory, so that's why the volatility is low.
Right. So you're anticipating what I'm going to talk about tomorrow, of course.
I'm not going to be here, so.
Oh, okay. Well, she's asking, so I drew up, you're back. Okay. So let me just go back to that credit surface. This is what tomorrow's talk is going to be about. I think here it is. Okay, so this says, depending on the FICO and the LTV, what rate you have to pay. And you could do this credit surface for corporates or for high yield. And the questioner is saying, volatility is low, that means it's pretty safe. So she's guessing that this credit surface must be quite flat, which it is, and that these corporations, because it's so flat, are borrowing like crazy. And isn't that a little analogous to what I was saying about what could possibly go wrong? And so, yes, I am saying that a little bit, but conditions are much better than they were in 2007 because there are lots of the rest of the economy, like the banks and the household sector, that's not very leveraged compared to what... Well, so we'll describe all that tomorrow. So I'm not anticipating an immediate collapse, but I am a little worried. And yeah, things are getting a little... So when things look the best, that's when you should be worried the most. So that's the...
Okay,
principle.
John, over here.
Yes. Sorry.
I have a question about forgiveness. For example, in 2009, 2010,
yes,
when there was a change of government in Greece, and they found out that Greece had cooked the books, and they'd also cooked the books getting the EU in the first place.
yes.
Would it have been smart for the EU just to say, Greece, we will absorb your debt, we'll kick you out of the club, you're on your own, you can reapply later? Would have been much better off just to forgive them very early and dismiss them from the group, then come back in later. It would have been cheaper, and we'd had a lot less trouble today.
Well, that was what many people recommended. So I'll repeat the question. He said, Greece, well, I'm going to talk about this tomorrow, but Greece suddenly, Papandreou announced that the deficit was really much bigger than it had been said, and that had been misstated. And by the way, I'm going to add a little tidbit, which you probably know, but it makes for a good story, which I would have told tomorrow. The guy who was the head of the Bureau of Statistics in Greece, who restated the debt, was born in Greece, but came to America to go to Amherst College, like Papandreou, by the way, who went to Amherst College. Anyway, went to Amherst College and stayed in America till he was in his early 50s, worked at the IMF, and saw an advertisement in Greece for the head of the Bureau of Statistics. And he didn't know anything about Greece, but he thought he was qualified, so he applied, and they gave him the job. And so he restated the deficit. And then he made it correct. And then he said, if they botched that deficit, probably the year before they didn't get right either. And he went back and examined that one and restated that one. And of course, that one was wrong too. He went back 20 years and kept restating all the deficits and made them correct. And last year, the head of parliament in Greece accused him of crimes against the nation, and and he was in dire jeopardy of being jailed. So with that background, the question was, when Greece had been revealed to have misstated its debt, wouldn't it have been better to forgive Greece's debt and let them leave the EU? And forgiving the debt right at the beginning certainly would have made things much better off for Greece and for the rest of the EU. A lot of the problems wouldn't have happened. So the question is kicking them out of the EU, probably you mean, I'm not sure how far out of the EU you mean. There are different stages of what you could mean by that, but the Greeks would have regarded that as a calamity. And so I'm not sure that was such draconian measures were absolutely necessary to kick them out of the EU. So I would have forgiven the debt, that's what I'm going to talk about tomorrow, and I would have thought about whether there's some other way of making them another thing you could do is you could somehow guarantee everything, so you would protect the rest of the EU, let Greece suffer, and now that Greece has suffered enough, then forgive the debt. So the question is how bad do you think kicking Greece out of the EU is? Is that for Greece, and is that for the EU? So I wasn't in favor of kicking Greece out of the EU, but that's certainly a policy. It has to do, it's forgiveness, and it's got some logic to it, and many people thought that Schäuble, the German finance minister, actually wanted to do that. So it's a sensible thing to think about. But I'm going to argue tomorrow that I wouldn't do that, have done that. Yeah.
Can the Fed forgive agency debt?
Can the Fed forgive agency debt? Well, that's a complicated question about whether the Fed can forgive. So which debt should have been forgiven is the question. And I was in favor of forgiving subprime debt. That's what I'm going to argue tomorrow. Now, why subprime debt? Because those are the people with the worst credit ratings. Those are the people who are the most underwater. Those are the people who are going to default anyway. So you're going to get the least amount of money back for them by throwing them out of their houses. They were the first to go, and that was the beginning of the crisis. So I was going to argue that you should forgive subprime debt of people who had kept up all their payments. In anticipation of them defaulting, you should forgive part of their debts. If they owed $160,000, the house was only worth $100,000, you should forgive it down to $90,000, because you could see that eventually they were going to default, and when they defaulted, you would get a terribly low recovery. Now, who was going to forgive the debt? I was going to make the lenders forgive the debt. So the lenders would be, so it wasn't the government who was going to have to, so most people think debt forgiveness involves the government holding the bag, but the subprime borrowers all borrowed from private lenders, hedge funds. So it was the hedge funds testifying in Congress that they wanted to forgive the debt because they could tell they would get more money back in the end by forgiving the debt than if the debt wasn't forgiven, and it wouldn't have cost the government anything. That's the argument I'm going to make. So the question about whether the Fed has the power to forgive the debt without the Treasury, I think yeah, the Fed would have to involve the Treasury in forgiving the debt and potentially running a loss. But I'm in favor of debt forgiveness that makes the lender more money. That's one of the conditions of forgiving the debt. You only do it when it's profitable to do it. And the crime and the tragedy is that even when it would be more profitable to forgive the debt, we didn't do it. So in answer to your question, if you thought that so I wouldn't be in favor of the Fed or Treasury together forgiving so much debt that they would run huge losses. I would be in favor of doing it in a way where they wouldn't have to run huge losses. Yes.
I noticed in one of your early graphs the high ratio of debt to disposable income in Scandinavia. Is there something specifically Nordic about that phenomenon?
You mean in various? Well, Irving.
Because it's the same from Finland to Norway.
Yes. Well, I wouldn't say it's specifically Nordic. In fact, Irving Fisher, you remember Shakespeare's Shylock, who gave the impatience theory of interest in The Merchant of Venice. He anticipated Irving Fisher, the guy I mentioned from Yale, who gave the modern impatience theory of interest, which is that interest depends on how impatient you are. And he said, the Nordic countries are the most patient people. They don't want to borrow very much money because they're so patient. Interest rates are always lower in the Nordic countries than in the southern countries. It's the Italians and the Greeks that are always so prone to borrowing. So I wouldn't say that it was a Nordic malady that explained that, but it is true that a lot of those Nordic, Ireland, England, they were all huge loan to value. So I'm not sure I could attribute it like Irving Fisher so confidently to their ethnic origin, but it does seem curious that all those countries up there had huge debt. Greece did not have high personal debts.
One last question back here, John.
Yep.
Wonder if you could talk about the time value of money and what it's doing to people that are retired and going to be retired shortly.
The time value of money, you mean the low interest rates, or? Well, one of the casualties of the low interest rates that the Fed has been holding now for years is that retired people have less, can't make money on their savings. So I'm not sure you're getting at this, but it raises the question about where do we stand with retirement programs in America, like Social Security, and how badly off are they? And in fact, why are they so badly off? So this story that Arrow had with the different time periods can be used to understand Social Security. So why do you think Social Security is in trouble? Why is it that it's running a deficit? Now, the usual answer is, probably this is what you think, that people are living longer now, or that there was a baby boom and now the baby boomers are retired, or that there are not enough children to pay for the old people. So those are the usual explanations, and of course there's some truth to all of them. There's another explanation. George Bush thought that Social Security was just wasting the money somehow. But actually there's no program in American history that's been so efficient and so careful about keeping track of all the finances. I mean, the expenses are less than 1% per dollar contributed gets paid out. It isn't paid out, but is paid to people who work in Social Security. My father died, and I remember thinking, I don't know who I'm supposed to tell. I don't know what's going to happen. But the few weeks later, his Social Security check had already stopped. I mean, they figure out things that fast. So they're not wasting the money. They've got a very efficient. So what is the reason Social Security is in trouble? Can anyone tell me what the reason is? What? Okay, so here's something that you might not have thought, but if you did that little reasoning with the different time periods, you'd realize it. Social Security began in the 1940s, it began 1938 and then 1940. Franklin Roosevelt started it, and what did he decide to do? He said, people don't save enough for their old age. So we're going to start in America, no one else had it, we're going to start a Social Security system where people are forced to contribute when they're young, and when they're old, they'll get paid the money back. And so we'll set aside the money and put it in government bonds. So that was how it worked for 2 years. And then his labor secretary, Frances Perkins, first woman secretary, said, there are all these old people now. They need the money right now. They're starving. Look at what's going on. You've got all these young people contributing, and the money's just sitting there. Let's give it to the old people. And then when the young people get old, there'll be more young people, and they can take the money from the new young people. So, sounds like a good idea, but, and it worked beautifully at the beginning. It solved the old age problem and all the destitution that was around during the Depression of the aged. But what actually happened? The people in 1940 who were turning 65, who hadn't contributed anything, they were getting Social Security. But it's not just the people in 1940. The people in 1950 who'd only contributed for 10 years, they were getting their full Social Security. The people in 1960 who'd only contributed for 20 years, they were getting their full Social Security. So for decade after decade after decade, we paid full Social Security benefits to people who hadn't made contributions, or at least not commensurate contributions. So of course, all of them did beautifully. They got huge returns. You compare someone, you know, when they're retiring in the 60s or 70s, compare their, you know, what they got, their old age payments, to what they put in, they made a huge rate of return. But finally, but what happened? Money was going out. It had to come from somewhere. So it's future generations that had to pay for it. So the way to think of Social Security is like if you've got a father who has an operation and you have to pay $1 million to save him, and you do it, then years later, you know, you're getting old and you say to your son, well, you're the grandson of, I've saved your grandfather and paid $1 million. Why don't you, you know, pay me $1 million now? And so the grandson can pay me $1 million. So I paid $1 million, I got $1 million back when I'm old. And then where is the loss? Well, the loss is in the interest, because the $1 million that I paid, I got paid back $1 million later, but it was a present value loss, the time value of money. So what we paid when we were young, we didn't make up for when we were old. So Social Security, this is how we're paying for Social Security. The gift that we made to the original generations in the 40s, 50s, and 60s, that gift is reenacted every generation. So if we were to stop paying Social Security right now, people like me who are about to retire, you know, not immediately, but anyway, when I'm about to retire, it would be me who wouldn't get paid, or you. We would lose our Social Security payments if we stopped Social Security. All that money that got given away can't be undone. It's reenacted the gift every generation. So the amount that was given away back then, 40s, 50s, 60s, in today's dollars, $18 trillion. That's where the Social Security problem comes from. We gave so much away at the beginning. I'm not saying it was a bad thing to do. We rescued all those elderly generations that were on the brink of starvation. But we have to face up to the fact that we made a gift, and somebody has to pay for the gift. So every generation pays a little bit of the gift. And that's why every generation from now on is going to get a bad return on their Social Security. We would have seen this 20 years ago, but we had the baby boom, which saved us, postponed the problem. So many people like me were contributing, baby boom generation, but we didn't do anything with those extra contributions. We just spent them. We didn't save them. Now that we're going to have the baby boomers retire, we're going to face that problem that we should have faced 20 years ago, and it's going to be bad returns for everybody. So that's the problem with Social Security. It was the gift we made to the original generation, and by thinking a little bit in these economic terms, it becomes clear. But if you don't think like that, you'd never guess that answer. Not one of you thought of that, even though that's the real reason why Social Security, it's inevitable in a pay-as-you-go system.
Okay, well, we'll see you all back here tomorrow night. Thank you so much, John.